For me, I haven't sold anything, and I actually think if I get to break even and I sell out, that'll be the stupidest thing. Because if this is indeed a new bull market in China, Hong Kong tech, then possibly this is the best time to buy. If you see in terms of China's CSI300 index, it has rallied since January by about 9.3%, correct? What about for Hang Seng? It's rallied 24%. In fact, year to date, Hang Seng has outperformed even S&P 500. Now, the reason for this massive rebound, some would say, is due to Chinese authorities getting really serious about stabilizing the stock market and restoring investor confidence. This has been an idea for years already, and maybe this final rescue plan of 278 billion is really a magic pill. I'll leave you to decide whether you believe in that or not. If you're in this, I'm never going to invest in China camp, this video may not be for you. On the other hand, I think this video is best if you are unsure, you are neutral about investing in China and Hong Kong because they have some real quality tech names over there, and you're willing to invest directly into Hong Kong listed tech stocks or indirectly via funds or ETFs with Hong Kong and China allocation. I think this video is going to suit you a lot. In today's sharing, I've prepared a few big names to keep you up to date on the latest performance for 2024. And before we get there, help me smash the like button, because right now I'm trying to keep up the schedule even though I'm recovering from a horrible flu bug. That explains a bit on this red eye that you see over here. So it's heart-earned sympathy votes also. Big thank you, and without further ado, let me get to the 3 big names that are leading all its peers in showing growth. The first, which is the biggest company in China, Tencent. Now, Tencent has released its latest earnings, and there is a big surge in terms of quarter-on-quarter performance. Year on year, the earnings per share growth is 56%. Wow. If this is a US listed firm and you get an earnings per share growth of 56%, you wouldn't blink paying 25 times price earnings ratio right now, correct? But this is Tencent, a Chinese tainted company. Then the question you may ask is, how sustainable is this growth, correct? I've done some homework to share with you. This over here is the gross profit, which excludes other investments and finance items. The gross profit is slightly lower at 23% year-on-year growth, but growth is seen across all 3 blue segments below, correct? The key one over there is value-added services, which includes social network, as we know WeChat, international games, and domestic games. This is where Tencent makes its bread and butter. And in China, domestic games, the top 2 names by a big margin, Honor of Kings and PUBG, they are owned by Tencent. So Tencent showing growth is fantastic news. That shows that domestic consumption has not evaporated. It's really exaggerated that China is going to zero. The second big name to bring up is PDD, Pinduoduo. Right now, PDD is the best performing big tech firm in share price terms. The reason for it is quite simple. It is one of a few which has shown growth in terms of profits over the last few quarters. In the latest quarterly results, they've announced that year-on-year earnings per share growth is 107%, which means a doubling of earnings per share. That's a massive gain, correct? And that's why also Pinduoduo's share price is close to its all-time high. Alibaba, on the other hand, has been languishing, which means also they've been caught up by Pinduoduo in terms of market cap. And the reason for it is because Temu is making a lot of international sales. That is really driving profits. I tried to do a deep dive into it, but as of now, PDD actually does not declare geographical segment breakdowns to show how much is growing in China and how much is growing internationally. But again, it reinforces that tech platforms and consumption, at least in China, is not dead. The third name is Xiaomi. Now, Xiaomi is one that I feel is truly global, because if you see what is their core product, smartphones, they have penetrated globally. Global market share is now number 3, behind only Samsung and Apple. And more crucially, China's growth is not crucial to it. It's growing hugely in Middle East, and it's actually the number 2 player there, and in Europe and in India. India again is the biggest, most populated country. So if they can penetrate there ongoingly, you can bet that revenues and profits will continue to grow. Xiaomi actually makes a lot of money also in the AIoT segment, which includes their wearables, the Xiaomi Watch, which includes tablets, and which includes also their large home appliances. These include fridges, washing machines, and my guess also the Xiaomi Robo Cleaner. Now, I've gotten great reviews of that. I kind of regretted not buying one myself because it's pricey, but it's a testament that they produce good products. Being a product specialist, Xiaomi's net margins are a bit thin. You'll see over here that they only make net profit margins of 8.6%. And this is vastly lower from tech platforms. But again, they are one that shows that product consumption is going up, whether it's domestic or foreign, and they've shown strong growth for a few quarters already. I brought up these three names to show you that, in a forest fire, everything gets burned down. But after the burning down process, there's always a few starting sprouts, correct? New shoots coming up. This could be what we are observing. The big ones are making profits already. Alibaba, unfortunately, is still a bit behind the curve. But to say that nothing will ever grow back is kind of an exaggeration. And if you think about it, the common worries about China over the last 3 years have been kind of behind already. For one, the China Common Prosperity Policy, which called for a big tax from Tencent worth $7.7 billion US dollars and $15.5 billion from Alibaba. All these structures have been in place already, and it's not even recent news. Yes, the political party is still the same, but what if moving forward, any calls for donation is no longer a shock to the markets? The second, China and Taiwan possible war. Kind of feels that this has quietened down already, right? Personally, I've even visited Taiwan myself just a year back. What about for China property market? Now the consensus is it's going to suck for years. The oversupply is just going to hang, and that will drain the wealth of the nation for quite a while. It's true, but there's also news that the rescue plan in 22nd May is very decisive. A $41 billion support to purchase unsold housing. That is in mainland China, but in Hong Kong, property volumes have already tripled in April 2024 because government has removed curbs on it. I'm highlighting this to say that there will be a bottom someday, but in any case, we're not investing into China real estate, correct? But I'm suggesting for you to invest in China tech or the Hang Seng Index right now. Now let me show you the Hang Seng Index first. This is its past 5-year performance, and I'd like to map it against the psychology of a market cycle chart. You would see that back in October 2023, it was all gloom and doom, correct? Because Xi Jinping got renominated indefinitely. Is that the anger phase whereby everybody is just so sick of this news and continuously blaming the government and shorting the market? That bottom has not been breached even for the next half year ahead already. What I'm seeing right now in this leg up and pullback is possibly this phase, the disbelief phase. Is this really a sucker's rally whereby it will go back down and lower? My guess is there's so much depression over the last few years already that is very likely suitable to be coined in this leg. In this disbelief leg, note again, we reverse back to the cycle, there will be hope, and then there will be optimism. By then, the market will start to shoot up. Let me know in the comment sections whether you agree with my observation or not. And in any case, if you're interested to invest broad-based in the China big tech, I have some names to suggest to you. The first is KWAP ETF. This will give you exposure to Tencent and Pinduoduo. This ETF is listed in US and one of the more liquid ones. Another name to suggest to you is the Lion OCBC Securities Hang Seng Tech ETF. If you want to invest from Singapore Exchange, or if you want to use SRS for investment, for example, then this ETF will give you exposure to Xiaomi and Tencent. Disclaimer again, this is not financial advice. Make sure before you make any purchases, you've done your due diligence. And thank you for watching right to the very end. With that, let me introduce you to some of my previous videos as to why I've invested in China tech right at the start. Check that out, or if you have seen it already, check out this other video that might help you in your financial journey. With that, that's all from me. I see you there. Take care as always. Goodbye.